It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
And I see that you just can't stay away from me. Hey everybody, it's Tyrone Jackson, the wealthy investor. If you can't stay away from me, I certainly can't stay away from you. But thank you for listening once again to the Trading Stocks Made Easy podcast. Okay, today I'm going to recommend stocks that I like in this market. Now, my recommendations don't mean that you have to like the stock, but I'm going to show you an important concept here today, which is the whole purpose of the show: wealth preservation versus wealth creation. Wealth preservation versus wealth creation. Now, I don't know if you've ever done any research on Yahoo Finance, where you can research all of your favorite stocks totally for free. I've loved it for over 25 years because the illustrations are nice and bright. You can check the 52 range, the 5-year range, the 1 month, the 1 day. A lot of free sites allow you to do it. I just think this particular site works really well because everything is easy to follow. Okay? So let's take a deep dive. If you're already rich and you're investing in the stock market, and I'd say already rich, meaning you have $1 million of income or more, right, every single year, you're rich. Why? Only 1% of the U.S. population makes over $250,000 a year. Did you know that? Yes. So if you have $1 million a year coming in income from your business, you're part of a very, very elite group. Although I will say, if you live in a big city like, Los Angeles, New York, or Miami, you're not going to feel like your $1 million is something special because there's certain cities that millionaires flock to. And Miami, Los Angeles, New York is certainly part of the top 3. Let's just say it that way. But that same $1 million in Albuquerque, New Mexico, right, or in certain parts of Iowa, you might as well be a billionaire, okay? So people who have more than $1 million in the stock market and invested, most of them are not looking for monthly residual income. They're looking to preserve what they have, and should their portfolio rise, they're happy about that, but they probably have a dividend strategy that is their form of residual income. Okay, so let's talk about that. There are certain stocks in the Dow that really don't rise too much over a 2 to 5 year period. They may go up 20%, 50%, but the dividend is so large that there are people who live off those dividends. Now, just for a quick review, what is a dividend? It is your share of a company's profits paid out on a quarterly basis or every 13 weeks. In other words, if I had a stock that paid $4 in an annual dividend, that basically comes out to $1 per quarter. But if you have 10,000 shares on that stock that pays an annual dividend of $4, you're earning on those shares alone $10,000. Those dividend checks that would be deposited into your bank account, nowadays we just have a direct deposit of our dividends into our checking account. That $10,000 shows up like clockwork. What do you have to do as a shareholder to take that $10,000? Absolutely nothing. Your online broker, when that dividend arrives in your brokerage account, they shift it automatically to your checking account. So if you're wealthy, hey, could you use an extra $40,000 a year for doing absolutely nothing? Most people can. What I do in my program, it's all about monthly residual income or 14-day residual income, depending upon how you're structuring your covered calls and your volatility trades. So when I come across people who already have $1 million, I know that they could be earning an extra $25,000 to $50,000 per month. But if they just have the money and no financial education about how the markets work, they're missing out on, let's say, $500,000 a year in addition to their dividends. All right, I'm going to get a little geeky on you here. This is not in the script, but I'm just going to go with it. If I know a rich person who has over $1 million and they're generating 2 to 5% from covered call writing per month. That's $25,000 to $50,000. If they didn't need the extra $25,000 to $50,000, I would then reinvest that money for them in high dividend paying stocks. In other words, I can take the money from the market to grow their dividend so they're getting wealthier and wealthier and wealthier. The hardest part for them was the $1 million. They've already achieved that. Now, for a lot of you, you're thinking, Tyrone, I hear you tell these stories and talk about wealthy people. Can I really get to $1 million in the stock market? Of course you can. Most of it is going to involve reinvesting your covered call profits on a regular basis. And of course, in today's market, reinvesting in stock splits. Okay? So stock splits don't mean that much to the average market participant, but it does mean a lot to you and I if we're in a wealth creation mode. Personally, my wealth has not gotten to the point where I am in preservation mode. I see the running road as being so large, I hope to never be in wealth preservation mode, always in wealth creation mode. Because even if you have $20 million, let's create some more wealth out of that, right? Again, especially if you live in a city like Los Angeles or Miami, you got a long way to go, or just move to the middle of the country and you'll be very, 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 very content. All right, so here's what I'm going to do. Because I like you so much, I am going to share my favorite stocks to own right now in this market. And it looks like, as of today, the last two stocks I'm going to talk to you about in this episode are my favorite stocks of all time. Okay? But I want to go through 3 stocks that are members of the Dow Jones Industrial Average and try to explain to you why these stocks aren't fast moving in this particular market. So here we go. In this market that we're in right now, the Wall Street community at large is really into almost anything relating to artificial intelligence. Why? Because the stock market is very future focused. They want to own the companies right now that are going to produce trillions, not billions, we're past that now, trillions in revenue, and AI stocks are able to do that. So who holds the most potential right now if we take a snapshot at this moment? Obviously, it's NVIDIA with their incredible platform. And who are their partners there? Amazon, Google, Oracle to some extent. They've got almost all of the pharmaceutical business. It looks like their generative AI products are going to be the ones that lead to the trillions of dollars in revenue first. But this is not an episode about AI stocks. It's really an episode about wealth creation versus preservation. Most of the people that are part of my program, and that means taking the online workshops and classes, as well as listening to the podcast, most of you are in wealth creation mode. You want to be at the point where you can earn $5,000, $10,000, $15,000, $20,000, $50,000 a month in covered call income. So I love teaching people who want to be wealthy, who want to be richer than they are, because we're in a market right now where the possibilities are endless. If you don't have a financial education, then guess what? You will be trading time for dollars for the rest of your life and, in effect, not participating in this wonderful transformation that's going on with regard to technology. So once again, I thank you for listening and being a part of the Wealthy Investor community. Now let's have some fun. Okay, so I'm going to give you 3 stocks that I once liked that Wall Street, to one extent or another, has abandoned, and then I'll come back with my 2 favorite stock picks of all time. By the way, you should try listening to this podcast every single week in your car. It's a great way to fill your time, right? There's nothing like driving and getting that inspiration that I try to give you every week, and most importantly, that knowledge that you need to take your portfolio to the next level. Okay? All right, so here we go. Ticker symbol JNJ, J Nancy J. That is, of course, Johnson & Johnson, member of the Dow Jones Industrial Average for a very long time. Also a member of the S&P 500 a steady eddy. However, 5 years ago, the shares were trading at about $124, and at the time of this recording, they're at $143. So everything we do in the Wealthy Investor Program is about snapshots in a 5-year period. If 5 years ago you bought the shares at 124 and right now they're trading at 143, are you happy? The answer should be yes, because the stock has appreciated, but it pays a dividend of $4.98. Almost $5 annually. That's about $1.24 per quarter. Now, you can't think small here like you've been taught in your real life. You have to think big here. So if you have 1,000 shares, you're taking in about $1,200 per quarter, just being mailed to your home. Now, a lot of people go, well, that's not a lot of money. No, it's not a lot of money, but it's passive residual income with no leaky toilets like real estate, no attorneys, no tenants who don't pay you on time, and no unexpected events like real estate. So that income is residual. You can do anything you want with that dividend. Most people, and here's a difference of opinion, most people will take the $1,200 and reinvest it to buy more shares. I'm not in favor of that, because if you were a covered call writer against those shares, you would have weekly or monthly income. But let's say you didn't know anything about covered calls and you were just there for the dividend. Very, very nice. Now, the stock hasn't appreciated that much, and most of the institutions that own the shares own at least 5, 6, 7, or 10 million shares. Well, what is $1.24 times 10 million? It's really good money is what it is. So those institutions that own those shares, they're not looking for a tremendous run in the stock. They are there for the predictable quarterly income that they receive. That is a wealth preservation strategy. It's as if you're saying, I want to be part of the market, but I don't want all the risk that goes with like the bigger names and the technology names, because those companies come and go in a heartbeat. So if you're into wealth preservation, you may want to own some shares of Johnson & Johnson. You'll be relying primarily on the dividend. Got it? Well, what about ticker symbol SBUX? Starbucks. Well, that's a member of the S&P 500. However, I always say don't buy the stock unless you understand the story. Meaning, unless you understand how the company generates its revenue, you probably shouldn't buy the stock because you recognize the brand name. 5 years ago, those shares at Starbucks were trading at $50 a share. Where are they right now? $72 a share. Do they pay a dividend? Yes, $2.28. Now, I have to tell you, this is where the momentum has shifted for this company. Starbucks used to be a leader in this customized coffee business. But ever since the pandemic, where people started to watch how much money they were actually spending on a grand latte, over the past 52 weeks, people stopped going to Starbucks, particularly in the United States, because gasoline got more expensive, the cost of living got more expensive, rents have gone up, and most people started to say, hey, I got to break this coffee habit. So therefore, the sales on a quarterly basis have showed a slight decline. The reason the stock has sold off from its high of 142 is because a decline in revenue is not what investing in a stock is all about. It's about dating companies that have increased in revenue. Therefore, the market has experienced a sharp sell-off in Starbucks shares. I sold mine because the trend changed, right? I love it when sales are rising at a company on that top line. But when top line revenue growth starts to slow, it is time to break up with that date, as we say in the Wealthy Investor Program, and redeploy that money into companies whose stock price are actually rising, right? So part of investing in a company is you're willing to take the ride and own their shares as long as the revenue continues to rise every 13 weeks. But Tyrone, it actually pays a dividend of $2.28. Weren't you happy with the dividend? Okay, revenue coming in will, pardon the expression, always trump the size of the dividend. I can't believe I just said that, but that's the way it goes, okay? So even though the dividend is good, if the revenue's not rising in the stock, I don't want to hold the shares because I'm in the game for more and more wealth creation, and I want my stocks to rise over time, not simply pay a dividend. Someone out there is going to say, but you could be selling covered calls against those shares. Yes, but if I'm selling covered calls against the shares and the shares are declining, all I'm doing is lowering my cost basis each and every month. And after 2 years of doing that, I will not own shares that are appreciating. So that's a sign to leave when the revenues decline. All right, next Dow component. And this hurt a lot of us in the Wealthy Investor Program because no matter how well you study a company, when that revenue starts to decline, it is time to sell those shares. Well, Nike, NKE Dow component. By the way, the revenues are rising, but not as much. And here's what nobody in the media will tell you. Michael Jordan's Air Jordan is responsible for a significant amount of Nike's revenue. And don't you know that those sneakers are still selling extremely well? Where Nike is having a problem is its direct-to-consumer unit, particularly in Europe, where people go to the website and buy things. Sales are slowing there. Now, we know what happened in Europe with their economy, that things slowed down there. They slowed down in the U.S. And even though Nike still pays $1.48 for the dividend, 5 years ago, the shares were actually trading at $70. They went up to $187. But when we started to see that lower revenue growth, guess what happens? It's as if the air started to come out of the tires. And guess what? The share price came down to where it is now, which is $72.53. On the last earnings call, the CEO was just like, we're trying to fix sales so we go back into growth mode, but we think it's going to take us at least a year. Wall Street was like, not on my dime. So the stock sold off, even though it had that $1.48 per share. So, lesson. When you're investing your money in the stock market and you're doing it directly, you are what's known as a retail investor. Self-directed retail investor is really the term. I don't care who you are as a self-directed retail investor, at least once a year we have a position move against us. Now you can sit there and watch that stock drop for as much as you want, or you could sell, redeploy that capital that was invested in that stock into another stock that's moving. And as long as we're in a bullish market, you're going to find, along with covered call writing, you're going to end the year up. So there's a strategy that I teach as to when to take your losses. There's a specific time I like to do it in the middle of the year, right? A specific month I like to do it. And then I redeploy that capital back into a stock where I'm writing covered calls. And if you do the math correctly, you will have more profits by the end of the year than if you just held the stock for the entire year. And when you sell your shares, that's going to trigger a realized loss on the shares. So there's some tax advantages to having real live losses. So there's some tax advantages to have realized losses in your account. This is why when you start to trade and invest in the stock market, you want to work with an accountant that has experience with traders, because losses are not bad. They are, and I just taught this a couple of weeks ago in New York, losses are strategic. There's a strategy to them. Why? Because when the very wealthiest of people created the stock market, the next thing they thought about was tax implications. So if you learn how to take strategic losses, they actually lower your tax liability on an annual basis. And that's a whole field in and of itself. But if you're one of those people that's sitting there going, I never want to sell at a loss, well, then you never want to take advantage of the tax code that allows you to use those losses against future cap gains. Much bigger story, but it's something I want you to think about. Now, believe it or not, it's time for a commercial break. But when I get back from this commercial break, what am I going to share with you? My top 2 favorite stocks I like right now in this market, and possibly of all time. Back in a moment.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't understand how to write covered calls for monthly income? No problem. Simply review Tyrone's latest stock trades in our video library as many times as you need. WITradeschool.com is all about helping you get the financial education you need to earn money in the stock market and change your financial life. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
And welcome back to Trading Stocks Made Easy. Now, I'm not going to tease you any longer. The next 2 companies, my favorite 2 companies perhaps of all time. And I want to tell you what it is. But I'm going to tell you that these aren't necessarily recommendations. And both of these companies, I think, are going to split in the not too distant future within the next 24 months. I love going on the record with that kind of thing because we can always look back and find out, was Tyrone right or was Tyrone wrong? Okay. My second all-time favorite, because I'm going to save the big one for number 1, is a company called Costco. COST is the ticker symbol. They've done well for quite a long time. You know what Costco is. It's that warehouse retailer, right, that caters to middle-class people who make $100,000 or more. Well, their big transformation actually happened during the pandemic when they couldn't have all those people actually filtering through the stores, and they added curbside pickup, which brought in hundreds of millions of dollars because middle-class people do what? Love their wine. I'm just kidding. Every time you go to Costco, as soon as you enter the store, no matter what store, it's all the wine that you could possibly consume, right? Okay, 5 years ago, this company was trading at $280 a share. Right before I went on the air to spend time with you, $884 per share. Well over a 100% return, and it keeps the same pattern over and over and over. You can count on Costco shares to rise 100% every 5 years. Why can they produce such a consistent result? And here's the answer. You ready? Because of that membership fee. Okay? So I just renewed my membership at Costco. I got the big, most expensive executive, whatever it is, the executive producer plan or whatever it is. I pay $120 a year. Now, have you noticed that annual fee creeps up every year? When you have an annual membership fee that is rising every single year, you're adding hundreds of millions of dollars to your top line. So therefore, the dividend also rises, and the dividend right now is $4.64 annually. So you're getting at least $1.25 per quarter. And I think Costco is going to split within 24 months because it's getting close to $1,000 a share. When your shares get close to $1,000, usually the board of directors says, hey, the retail investor, that would be you and I, really can't afford our shares and we'd like for them to participate, and they split the shares. I think we're due for about a 10-for-1 stock split, which would be great for you if you're listening because you get a piece of that dividend and the growth. Okay? Costco is also famous for what we call a share buyback that shrinks the float, and that puts pressure on the stock to rise. See, if you're in a mutual fund and you don't understand what goes on behind the scenes, you are in effect locked out of all the growth that can come from owning the shares directly. Okay? So I love Costco. I recently renewed my membership. I stood by the door and I watched for 20 minutes while they did all the paperwork. I must have seen at least 100 people in 20 minutes leave with their shopping carts full. And that's just one location in Los Angeles. So I love Costco. I love the revenue. I love the growing revenue. That dividend is absolutely stunning. And when I went in there and I saw that they had cow tongue on sale, I knew I was in the right place. I was like, what am I going to do with all this cow tongue? How much of it can I take home? I've never eaten cow tongue, but they had it on sale at Costco. Don't let that throw you. It's just the truth of my experience. All right, are you ready? This is my number one favorite stock of all time. It happens to not be a member of the Dow Jones Industrial Average, but I made so much money on this stock, and my students made so much money about 5 or 6 years ago. And here's the name. I would ask for a drum roll here, but you just have to imagine in your mind. You ready? Ticker symbol, NFLX. And that's only one company, which is Netflix. 5 years ago, the shares were trading at $299. And where are they right now? $697. Let me tell you what I love about Netflix. We're all going to wind up paying $49 for Netflix within the next 2 to 5 years. Yeah, I know it's like 21, but they are the leader in their field. No one can touch them from a technological point of view. No one can touch them from a content creation point of view. If Eddie Murphy and Beverly Hills Cop was just released on Netflix, I saw some stats the other day, 41 million views. That means that fans on Netflix have watched that movie at least 41 million times in the first 10 days of the release. If there's one thing I've learned in life, you can't beat Eddie Murphy in anything, and you can't beat Netflix. Netflix has a strategy of using urban comedians to draw new subscribers all around the world. And it's working, and it's working, and it's working. So if they pay Chris Rock, let's say $40 million, they pick up millions of subscribers around the world as a result. Do I think Netflix shares are going to go higher? Yes. But you probably want to wait for the next 10-for-1 stock split. But I think there's really only going to be 3 major streaming services within the next 2 years. It'll be Netflix, Disney Plus, and maybe just one other. Why do I say that? Because there's an awful lot of consolidation going on in the streaming world. Because they can't pay all of the fees to the companies that are hosting their streaming products. Who am I talking about here right now? AWS, Amazon. Most of your big streamers are paying hosting fees to Amazon. And let's just put it this way. Amazon is not going lightly on them. So if you have rising costs to deliver the content until you can find another platform to host it, a lot of these companies are going to go out of business, and they're going to be bought. By who? Netflix, HBO Max, or some larger conglomerate we don't know about right now that has the buying power. So if Paramount is being sold, like they're in the middle of negotiations right now, what is that telling you? Hollywood is shifting. Hollywood is shifting towards being digitized, and the biggest player in digital is Amazon. By the way, what's the object of the game in Monopoly? To play and live harmoniously with all of your competitors? No. One many. It is to be the only one left at the table. I'm trying to tell you something right now, and I know I'm correct about this trend. Why? I watch the revenue at all these major companies. So if you want to own stocks to create wealth, you're probably going to own stocks that don't pay a dividend because they have not matured yet. But when you get to preserving what you have, there's always going to be that balance between companies who pay a dividend and companies who are growing. And that's in part what the Wealthy Investor Program is all about, owning the dividend payers for their stability and trading and investing in the companies that are on their way up. Hey, there's nothing like getting a financial education in the world. Stick with me, the Wealthy Investor, and as the market changes, I will always be the first to let you know in layman's terms. Tyrone Jackson, the Wealthy Investor, saying thank you for listening to this episode. Thank you for your willingness to keep an open mind, and thank you for your desire to change your life. If you want big changes financially, not only am I your guy, I can tell you they are on the way because our world is evolving technologically. Why not cash in on it by owning the right stocks? I'll see you right here next week, same time.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.